We're joined by billionaire Wilbur Ross, the CEO of W.L. Ross & Company. He's going to be with us for the next 2 hours. Also, our very own Rick Santelli is here in studio with us. We've got Kevin Ferry of Cronus Futures Management. He made the trip out from Chicago with Rick, so we're calling this the Chicago invasion today. Plus, our very own Steve Leisman is here to try and keep things in order, or should I say disorder? Yeah, how are we going to take it this morning? We're going to take a look at this. Let's check out the futures first of all. We have seen a turn in the futures this morning. In fact, things are picking up quite a bit. Right now, those Dow futures up by about 47 points above fair value. The S&P is up by over 6.5 points above fair value. This is happening as oil prices have remained relatively steady, just up by about 34 cents right now, $114 just above that for oil prices. Let's get straight to our all-star panel this morning with Wilbur, Rick, Kevin, and Steve. That's a mouthful. You know, first of all, Wilbur, we want to join you to the party. We've been here for about an hour talking things through. But we've been talking an awful lot about the credit crunch, the credit crisis, where things stand. And I know you've got some ideas about how this can be fixed.
Yeah, I do. I really think that in order to get the system back functioning, particularly mortgage system, there should be a good bank, bad bank concept applied to Fannie Mae and to Freddie Mac, so that you segregate out the real problem loans, the ones that are already delinquent, finance them separately rather than let them pollute and complicate both the financing and the management part of trying to make new loans.
When you talk about splitting the good and the bad, though, you're only talking about delinquent loans that would be part of the bad bank?
Delinquent loans and the very high-risk ones, because those are the parts that are going to fall off the cliff as we go forward. And that's also what complicates getting more financing into Fannie and Freddie.
So that was a successful policy in the regional banks and the S&Ls. But so, Mr. Ross, are you saying that they would create a third entity, a new type of Margie or whatever you want to call it?
Whatever you want to call it. Yeah. Problem May or
Problem May. Okay, and they would take these. Loans off the balance sheet of Fannie.
Yeah, because then you'd let management be able to focus on what will really get credit markets going, which is making new loans. You can't get the credit markets going just by fixing up and replacing the damage done by the bad loans.
Right. One of the things that I think has been underestimated by the people involved in this as a frontline kind of soldier is that unlike the futures markets, where there was a readily available bid and ask spread for these products, no matter what was going on in the world, what do you think they need to do to support the concept of a secondary market? Because these people literally just said they were no longer in this business, and you're seeing that with auction rate securities also.
Well, Wall Street is very good at solving last year's problem, and I think that's really more what those two things say. There's nothing fundamentally wrong with auction rate securities, but when the people who were supposed to stand behind them walk away, that's what created the problem. It was nothing inherent in the paper itself.
Guys, can I break in real quickly? We've got Lowe's numbers coming in right now. The company coming out with earnings of 64 cents a share versus the 56 the street was looking for. But it's not all good news here today. The company's also talking about the comps being down 5.3%. Significant headwinds, they still say, coming on the macroeconomic front. And in fact, if you look at the earnings per share, when they start talking about their outlook, they're now looking for earnings per share of 27 to 31 cents. For the current quarter. Street was already at 33 cents, so you are talking about a warning that they're issuing for that current quarter. We'll see how the Street takes this today.
Beck, I see here they're saying Q3 same-store sales they see down 5 to 7%.
That's right, 5 to 7% when you look at the same-store sales, but more important probably the expectations for net income 27 to 31.
Seems to be a theme out there where people are beating the current number but warning about coming quarters. And by the way, that's exactly what's going on in the macro forecast right now, which is that they're going to revise up 2Q from 1.9 to 2.7 and change. But everybody is bringing down 3Q. I got 0.5. I guess it was Lehman I was reading this morning. And then the macro advisors on 4Q is minus 0.7. So that's the same thing happened on the macro levels happening in the profit outlook here.
Well, Wilbur, let us ask you about that, too, just what you see on the macro level at this point. We've been hearing from many of the CEOs over the last few weeks talking with earnings about that pressure that's coming on the consumer especially. What do you see?
Well, I think the consumer has been tapped out and psyched out for quite a little while. Consumer debt, as you probably know, now exceeds the whole gross domestic product of the country. That's kind of a scary ratio. You're talking something like $15 trillion of consumer debt. I think the more interesting thing with the consumer is that historically the last thing they would walk away from was the mortgage. Now it tends to be the first thing. And I think the reason is they need their credit cards because they're using them to buy groceries, to buy everyday things. It isn't just that they're using them for the once-in-a-while big purchase. So the credit card becomes a very, very vital tool. And so that's why I think they're paying that off a little better than they are the mortgages.
Wilbur, can we go back to this idea you had earlier, which is good bank, bad bank?
Right.
Which, again, as Kevin said, is something we did basically in the 90s when we did the RTC.
Sure.
We took the bad assets, we put them into a place, and we basically sold off bonds relative to that, and the private sector came in and financed it. Yet you have an administration here that continues to say no bailout. Effectively, over the 10-year period, the RTC actually made money when they redeemed all those bonds. But initially, you have to sell it, as we're going to come forward, basically with public money to finance that. Is there the political, what's the right word, climate right now in Washington to do this sort of thing, even though it seems to make sense?
Well, maybe not, but a climate change is due in a very few months.
So you think a new administration comes in and they say, hang on, clean hands, we got to separate out. But why just stop at Fannie and Freddie? Why not have a bad bank, good bank for Citigroup or for Lehman or for all these other guys holding this stuff on their
Well,
books?
I think the difference is they've crossed the Rubicon, and now the guarantee of the Fannie and Freddie debt is quite explicit. And I think that's what makes a big watershed difference. Before, it was an implied guarantee, and while everybody thought it was probably pretty good, that recent act of Congress makes it 100% clear that they are going to do it.
But do you need to do for other banks, though?
Well, in terms of bailout concept for Fannie Mae and Freddie Mac, it's only a bailout if you leave the shareholders unimpacted. So the fact that something may need federal help doesn't mean that you have to bail out everybody.
Let's go back to the hair of the dog that bit us and securitize our way out of this.
Okay, we're going to talk a lot more about this morning. Again, Rick, Steve, Wilbur, and Kevin are all here for the rest of the show. We got a lot of ground to cover.